Hey everybody, and welcome back. I'm Adam Black, your lender for your life. Today, we're diving into a topic that often confuses many American consumers, the difference between the Federal Reserve rates and mortgage rates. If you're looking to buy a house or obtain a home loan, this is crucial information for you. So let's clear up some common misconceptions and help you understand how these rates actually work. You may have heard news about the Federal Reserve increasing or decreasing rates. Naturally, this leads many to think, oh my gosh, mortgage rates are going up, or great, mortgage rates should be going down. However, the reality is a bit more nuanced. All right, first, what is the federal funds rate? The federal funds rate, often referred to as the Fed rate or even the prime interest rate, affects things such as credit card rates, business loans, the interest rate banks charge each other for overnight loans. These are not the same as mortgage rates. The Fed rate directly impacts short-term loans and lines of credit, such as home equity lines or HELOCs as we call them, credit cards, but not fixed mortgage rates. So what determines mortgage rates? Well, mortgage rates are determined by the market for mortgage-backed securities, or you'll see those listed as MBS. Here's a quick breakdown. These are bonds secured by home and other real estate loans. The prices of these securities are traded daily on the market. When the price of MBSs go up, mortgage rates go down. Conversely, when MBS prices go down, mortgage rates go up. Okay, then what's the relationship between Fed rates and mortgage rates? While it might seem logical to assume that mortgage rates would follow the Fed rate directly, they do not move in lockstep. Here's why. Mortgage rates and the Fed rates often move independently. There are days when the Federal Reserve announces a change in the Fed rate and mortgage rates move in the opposite direction. In fact, early on in my career, this was pretty much a given. Mortgage rates are typically a leading indicator of the economy. This means they respond to expected future economic conditions. The Federal Reserve adjusts the Fed rate based on recent economic events, essentially looking in the rearview mirror at lagging indicators such as inflation and job reports. This reactive approach means their adjustments are based on past data, whereas mortgage rates are more forward-looking, if you will. So I'm sure you're asking why this matters. Understanding the distinction between the federal fund rates and the mortgage rates is crucial for several reasons. Knowing the difference helps you make better financial decisions, whether you're buying a home, refinancing, or taking out a home equity line. It prepares you to better understand market movements and economic news, helping you anticipate changes in mortgage rates and being more accurate. Also, when discussing loans with your mortgage professional, having this knowledge ensures clear and more productive conversations. In summary, while the Federal Reserve's rate changes can influence economic conditions, they do not directly dictate mortgage rates. Mortgage rates are primarily driven by the MBS market, which operates on its own set of dynamics. If you found this explanation helpful, please share this video, give us a 5-star review, and subscribe to Your Lender for Your Life for more insights. And remember, for personalized advice, don't hesitate to reach out to us. Thanks for watching, and see you next time.